Hello everyone. In this video I'm going to be talking about notes receivable. And notes receivable is different from accounts receivable is that it's documented. It's in the form of a paper, a document. So it's a written agreement between two parties. Unlike the accounts receivable, it's just verbal agreement. A notes receivable has some advantages over accounts receivable. Because by signing a note, the debtor recognizes the debt and agrees to pay it according to its terms. Therefore, a note is stronger legal claim. So in court, a notes receivable is a much stronger way to prove that this person owes me some money. So what are the characteristics of note receivable? One of the well-known type of notes receivable is what we call it a promissory note. So a promissory note is a written promise to pay the face amount, usually with interest on demand or a date in the future. Some of the characteristics of the promissory note are that we have a maker, which is the party making the promise to pay, or sometimes we call them the issuer. Then we have the PE, which is the person to whom the note is payable, and sometimes we call them the beneficiary. The face amount is the amount for which the note is written on its face. The issuance date is the date a note is issued, which is typically the date that it gets signed. The due date or maturity date is the date the note has to be paid, and the term of the note is the amount of time between the issuance and the due date, so like the length of the notes. Like it was issued, let's say, January 1st, 2010, and it's going to be due on December 31st, 2015. So that's the term of the note. Then we have the interest rate, which is the rate of interest that must be paid on the face amount of the term of the note. So let's say it has a face amount of $1,000. The interest rate is 10%. So 10% of the $1,000 is going to be paid as interest. So this is how it looks like. This is, of course, like a typical kind of note or a promissory note. And let me follow the numbers here. So under number 1, we have the maker, which is the person who signs the note. That's the person who has the obligation to pay the amount of the note at maturity. In other words, we can call that person the borrower. Then if we look for number 2, that's PE, that's the lender. So that's the person that's going to receive the value of the note at the date of maturity. So as you can see here, it says the order of Pearl Company or Pearland Company. Then number 3 is the face amount, which is how much it's going to pay, which is $2,000, and it's usually written in numbers and also in writing. One thing I want you to know that from a legal perspective, if let's say this is 2,000 and here it's 20,000, then the person or the person has an obligation to follow what's written in writing. So whenever you are signing a note or receiving a note from somebody, make sure that the correct value is the value that's written here, which is written in writing. Because if there's contradiction, then this is, again, the only thing that the court is going to accept is what you have in writing. So let's say somebody wrote here $1,000, but in writing just wrote $100, then they owe you only $100. Then number 4, the issuance date, and you can see here it was issued in Fresno, California on March 16, 2018. And then we have number 5, the due date, and you can see here this is a short-term note. It's only a few months between March 16 and June 14th, which is about 3 months or 90 days. And you can see that in number 6, which is a term, 90 days. And number 7 is the interest rate, where it's mentioned here, value received with interest at 10%. So that person is going to pay Pearland Company the $2,000 plus 10%. And by the way, this 10% is an annual rate. So we need to adjust it for the 90 days. And we typically multiply 90 divided by 365. Sometimes for simplicity, we just divide it by 360 days. So the due date of June 14th, 2018 is computed as follows. And that's another thing I hope you can understand how to calculate, because you should expect one of these questions in the exam. So the issuance of this note was on March 16. So what we do is that we see how many days we have in March. And I hope you know that like some months are 30 days, some others are 31, and only February it's sometimes 28. If it's a leap year, it's 29 days. I don't know if you know the knuckle trick, so it's usually January, February, March, April, May, June, July, and then you start over again August, September, October, November, December. So when we start with January, if it's on the knuckle, then it's a 31 day. If it's between the knuckles, it's 30 days. Just a trick for you if you don't really memorize which month have 30 days and which one have 31. So March, let's say here, January, February, March has a knuckle, so it's 31 days. So we start with 31 days, and then we deduct the issuance date, which is 16, because it was March 16, and that would tell us that we have 15 days left in March. Then the next month is going to be April. It's 30 days. So 30 plus 15 is 45. We're not close to the 90 days yet. So we add the month of May. It's another 31 days. So 31, 30, and 15, that's going to be 76. So we're getting close to the 90. So we cannot use the entire month of June. So we only use 14 days of June to reach the term of the note, which is 90 days. So that's usually how we know. So this number here, the 14, is our focus. So we do that as a plug-in number, but we have to keep adding the number of days in each month until we get closer to the 90 days or the term of the note, and then we plug in the value that would make it equal to the term of the note. So again, one more time here, we have 15 days left in March, which is calculated 31 minus 16. Then we have 30 days in April, 31 days in May, and then we only use 14 days in June to make the term of the note, which is 90 days. So the interest on the note is computed as follows, and as I mentioned before, interest is equal to face amount multiplied by interest rate multiplied by the term. So the face amount is the $2,000, the interest rate is the 10%, the term of the note is 90 days over 360. So make sure that you always consider the term of the note, because if it's this interest rate is always an annual interest rate, so we need to adjust it based on its term. And in this case, it turned out to be 50. For simplicity, we're using 360 days per year. Of course, we know that a year is 365 days. If it's a leap year, it's 366. In a banking system, they do it very precisely. They go day by day. But again, for class purposes, we just try to simplify it for interest calculation by going with the 360 days. So the maturity value is the amount that must be paid at the due date of the note, which is the sum of the face amount and the interest rate. So in this case, the maturity value of the note is $2,050, which is calculated as $2,000, which is the face value of the note, plus $50, which is the interest that we just calculated. One easy formula that I always try to remember when I'm calculating interest is that interest is equal P multiplied by R multiplied by T. And P stands for principal, which is the face amount, R is for the interest rate, and T is for the term. So PRT, or time. You can call it term or time. Principal multiplied by rate multiplied by term or time, and that would be your interest calculation. So now let's see the accounting side of it. So a promissory note may be received by a company from a customer to replace an account receivable. In this case, the promissory note is recorded as a note receivable, and we'll see how this works. So assume that a company accepts a 30-day 12% note dated November 21st in settlement of an account of WA Bond Company, which is past due and has a balance of $6,000. The company journalizes the receipt of the note as follows. So we already have an accounts receivable existing, it's past due, and the customer said, okay, I'm going to sign you a note instead. So we're canceling the accounts receivable by crediting it, and I hope you remember accounts receivable is an asset. When we want to cancel it or reduce it, we record it on the credit side, and then on the debit side we record the notes receivable, which is another asset, and it's going to be increasing, so that's why we debit it or record it on the debit side. So we have November 21st, where this transaction took place. We debit the notes receivable for WA Bond Company, and we credit the accounts receivable for WA Bond Company, and both for $6,000. At the due date, the company journalizes the receipt of the $6,060, which is the face amount plus the interest. And how did we calculate the interest? It's $6,000 principal, 12% interest rate multiplied by 30 days divided by 360 days per year on average. So this is going to be $60, so the amount of interest revenue is $60. So let's see how we do this journal entry on December 21st, which is after 30 days. We debit cash for the total value of the principal plus the interest, so that's $6,000, $60. And then we credit the notes receivable because we want to cancel that notes receivable for $6,000. And then we recognize the interest revenue on the credit side. And I hope you remember, revenues, whenever they're earned, they're recorded on the credit side. And that's for $60. So if the maker or the issuer of the note fails to pay the note on the due date, it's considered a dishonored note receivable. And in this case, we convert it back to accounts receivable. So a company that holds a dishonored note transfers the face amount of the note plus any interest due back to an accounts receivable account. So let's see this example. Assume that the $6,000 30-day 12% note received from WA Bond Company and recorded on November 21st is dishonored. So what are we going to do? Instead of having the cash, we're going to be debiting accounts receivable. So exactly the same thing that we had before, we're going to debit accounts receivable and we're going to credit notes receivable for $6,000, and then we're going to have interest revenue on the credit side. So a company receiving a note should record an adjusting entry for an accrued interest at the end of the period. So what if the interest or the year end is during the life of the note? And this is what we're going to see in this next example. So assume that Crawford Company issues a 4,090-day 12% note dated December 1st, 2013 to settle its accounts receivable. If the company period ends on December 31st, the company receiving the note would journalize the following entries. So let's keep in mind that this is a 90-day note and it was issued on December 1st. So the maturity is going to be 90 days from this December 1st, which is going to be in the following year, which is year 4 or year 2014. So on December 31st, we need to make sure that we make an adjusting entry to accrue the amount of interest revenue that we earned but we haven't received. And at that time, we have to record interest receivable. So on December 1st, we debit notes receivable and we credit accounts receivable for $4,000. And that's what we've done in the previous example. The new thing here, on December 31st, we're going to calculate the first month interest that we earned for the first 30 days. So we're going to debit interest receivable and we credit interest revenue. Why didn't we debit cash? Because we haven't received this first month interest. We're going to receive it at maturity. So this is going to be earned, but it's not received yet. So that's why we have interest receivable, and then we're going to credit interest revenue. But keep in mind here, we're using only 30 days. We're not using the 90 days for the full period of, or the full term of the note. The remaining 60 days are going to be used in the following year, which is 2014. However, the cash is going to be for the entire 90 days. So on March 1st, 2014, when the company receives the full balance, maturity value, which is $4,120, and how did we calculate that? It's the $4,000 face amount plus $120 interest. And how it's calculated, it's the 12% multiplied by the 4,000 multiplied by 90 divided by 360, and that's going to be $120, and that's the amount of interest received for the full 90 days. However, remember, we already earned 30 days. We need to earn the remaining 60 days. So we're going to debit cash for the full value, which is the amount of the note plus its interest, so $4,120. We're going to credit the note. We're canceling the note for its face value, $4,000. We're going to cancel the interest receivable because now we received the cash for it, which is the $40. You can see here that we had interest receivable of $40 on December 31st. We're going to credit it because we're going to get rid of that, and then we're going to earn the interest revenue for the 80 days. For $80. How did we get the 80? It's simply 4,000 multiplied by 12% multiplied by 60 divided by 360, which are the 60 days related to the months of January and February. So this is not presented here, but you can do the math on your own, and it should be $80. Alright, so this is a checkup corner to check or verify your understanding of how notes, receivable calculation, and interest work. So I'll leave that for you to practice. And here let's talk about how we report the receivables on the balance sheet. So all receivables that are expected to be realized in cash within a year are reported in the current assets section of the balance sheet. So if it's less than a year, we should expect it to be part of the current assets. And then you can see here we have Morning Joe, the balance sheet for December 31st, 2016. And under current assets, we have this line for cash for accounts receivable, 305,000. And then we subtract the allowance for doubtful accounts for 12,300. And then we get the net accounts receivable, which is 292,700. So sometimes we refer to that also as the net realizable value of the accounts receivable. The last thing in this chapter we want to talk about is some ratios, which is the first ratio here that we're going to be covering is the accounts receivable turnover ratio. And that's a very important ratio because it tells you how long it takes you to issue an accounts receivable and collect it from the customer. So the accounts receivable turnover measures how frequently during the year the accounts receivable are being converted to cash. So how we calculate the accounts receivable turnover ratio, it's a very simple ratio where we divide sales by the average accounts receivable. Remember, average is the beginning plus ending divided by 2. So this is the beginning is the ending of last year, and then we add to the ending of this year, divide them by 2, and that will give us the average accounts receivable. Sales is an income statement account, so we bring it from the income statement. Accounts receivable is a balance sheet account, so we find it in the balance sheet. So let's see this example from a company maybe we know, or maybe we use their product. It's Keurig Green Mountain, which is this company that makes the coffee makers and their coffee. So they have year 1 and year 2. We have the sales, and again we have the beginning and ending accounts receivable. And as expected, the ending of year 1 is the beginning of year 2. So we're going to calculate the average accounts receivable for year 1, average accounts receivable for year 2, and then we're going to divide the sales by the average accounts receivable. So this is how it's done. So we have the accounts receivable turnover for year 1, which is 43.58, and then we get the average accounts receivable. And then, and by the way, the 43.58 is our sales value. And that will give us 43.58 divided by 416, and that's 10.5 times. For year 2, we do the same thing, but we got a lower value, 8.6. Is a higher number better or worse? Of course, a higher number is better. So if you have higher turnover, that's a better indicator. However, if it's too high, it just tells that management is too pushy in collecting their accounts receivable, which is also not a very good thing. Another ratio that's related to that is something called the number of days sales and receivable. And this ratio is an estimate of the length of time the accounts receivable have been outstanding before it gets collected. So how we calculate it, it's the average accounts receivable divided by average daily sales. And how we get the average daily sales? It's simply sales divided by 365 days. And I know some people might think, why we're using 365 now? In the interest calculation, we're using 360. Again, you can use the 360, but for this specific ratio, it's commonly used as 365 days. So again, using the same information, let's run the ratios. And you can see here that we use the 365, and it turns out to be 35 days to collect your accounts receivable under year 1, and it got worse a little bit. It got longer, 42.2 days to collect your receivables in year 2. So here's a comparison of these ratios to another competitor, which is Starbucks. And this is the purpose of these ratios, is to compare your performance to others or maybe yourself over time. And you can see here Keurig is the green one. Their accounts receivable turnover is lower compared to Starbucks over the 2 years, and you can see that Starbucks is somehow stable. It was 12.9 and it's getting better, 13.2, but for Keurig it went down a little bit. For the number of days sales and receivables, you can see that this works the opposite way. So for year 1, Keurig was 35 days and went up to 42.2, but for Starbucks it's only 28.4 and it got better in year 2, which is 27.6. So I hope you get the sense of the value of these ratios. We're going to practice these in the annual report experiences, but I think this is the main purpose of learning accounting, is to be able to analyze what the numbers means. So by this, I'm going to end chapter 8. Thank you for listening. I wish you best of luck, and let me know if I can be of any help.